Hello traders, you're welcome to this video. In this video, we are going to be discussing a strategy that combines the commodity channel index and the stochastic oscillator. Okay, so we're going to be looking at how to effectively combine the CCI and the stochastic oscillator for high probability trades. Okay, so first of all, we're going to be understanding how these two indicators work. First of all, let us load the indicators to our chart. I'm going to load the CCI and the stochastic oscillator. We load them both to our chart, right? So the CCI is a momentum-based oscillator that measures the deviation of an asset price from its average. It ranges from minus 100 to 100, with values above 100 indicating an overbought condition and values below minus 100 signaling an oversold condition. This makes it useful for spotting potential reversals. Now, as for the stochastic oscillator, it compares the closing price to the range of prices over a specific period. Now, the default setting is 14, okay, usually 14 periods. It consists of two lines, the percentage K, which is the main line. You can see the main line is this green line, that's the percentage K, and the percentage D is a moving average of percentage K, okay, the moving average of percentage K, which is the signal line, okay. Now the stochastic oscillator ranges from 0 to 100, as we can see here. Values above 80 signifies overbought conditions, values below 20 signifies oversold conditions, okay. All right, now for this particular strategy, we are just going to be using the default settings. We can see the default setting for CCI. We're going to leave it at period 20, and as for the stochastics, we're just going to leave it at period 14, 3, 3. That's this, right? All right, and we're going to be focusing on the overbought and oversold zones, okay. Now, how do you identify market reversals with the CCI? As for a bullish reversal, when the CCI moves from below minus 100 and crosses upward into the neutral zone, it can indicate a potential reversal to the upside. On the other hand, for a bearish reversal, when the CCI moves from above 100 and crosses downward, it signals potential downside, okay. Now, how do you confirm your signal with the stochastic oscillator? After spotting a reversal signal with a CCI, use the stochastic oscillator to confirm the entry point. It's very important. So for a buy trade, you wait for the CCI to cross back minus 100 as an initial sign. It should be pointing up, okay. Then check if the stochastic oscillator is below 20. In this case, it was not below 20, so we are going to ignore that signal. Let us look for another one. We can see in this one, the CCI was pointing upward from the minus 100 and the stochastic was in the below 20. Okay, this is a good one. So as for our entry, after this happens, you can then enter your buy. I can see that price went all the way up to this point. You can enter our buy and set our stop loss below the swing low. Take profit can be at the nearest resistance or just wait for when a crossover in the stocks happens. Both the stocks and the CCI should start pointing downwards from the overbought regions. Then as for a sell, it's just the opposite, okay. You wait for the CCI to cross back below 100, then you check if the stochastic is above 80 and crossing downward, okay. If the percentage K crosses below the percentage D, that is the red line, the main line crosses below the signal line, that is the green line crosses below the red line, it confirms the bearish momentum. So we would have considered entering a sell around here. Stop loss can be above the swing high, take profit can be at the nearest support zone, or you can just wait for when the price enters the oversold to exit your sell, okay. Now, it is also very important that you consider risk management, okay. Do not trade with an amount you cannot afford to lose, and always use good risk to reward ratios. So now, as for our stop losses, it's important to set it below the most recent low for a long trade and above the recent high for a short trade. If you enter a long trade here, Below the recent low, you set your stop loss. Enter a short trade above the recent high, you set your stop loss. Okay. And in order to avoid false signals, try to avoid trading during extremely volatile conditions, because both indicators can give false signals when the volatility in the market is very high. So you wait for the CCI and stochastics to align properly. It's very important. Wait for both the CCI and the stochastics to give you the same signal before you enter the trade. Do not just enter a trade based on signal from one of the indicators alone. Now, as for the time frame, this strategy works well on the 15 minutes time frame, on the 1 hour time frame, and the 4 hours time frame. Okay, but you should always test it based on your trading style. You can test it on other time frames of your choice. Actually, yeah, it also works on other time frames depending on your type of trading. If you are a scalper, you might want to use very small time frames. If you are a day trader, swing trader. So the strategy works across different time frames. Okay. So by combining the CCI and stochastic oscillator, you are stacking two complementary momentum indicators, making it easier to spot high probability trading opportunities. With careful practice and risk management, you can apply this strategy effectively in various markets. You can apply it effectively in various markets. So I hope you found this video insightful. Kindly like and subscribe for more trading insights. Thanks for watching. Happy trading.